Real Estate Hustlers podcast. I'm your host, Josh Appleman, and today we're joined with Monika. Monika is a real estate investor and co-founder of RPI Education, helping individuals build wealth through smarter investing, financial strategy, and long-term planning since 2010. Monika, we appreciate you coming on the show today. If you could, let the listeners know a little bit more about yourself.
Oh, thank you so much for having me on your amazing show today. Like you said, my name is Monika Jazyk. I am a real estate investment specialist and wealth builder and founder of RPI Education. And I've been investing, a full-time real estate investor, for over 16 years now. So a long time in the market, and we've done all different types of investments, types of strategies, and we also operate as consultants to help other people build wealth through real estate and alternative investments as well.
Got it. Good deal. Take us all the way back to the beginning. So the first real estate transaction that you had, how you got into it, how you found it, all the things.
Oh my goodness. Well, the first real estate transaction we ever did was many moons ago. We knew we had to create wealth for ourselves and our family. I do have 4 kids, and we found ourselves, like so many people do, trading time for money. And I really wanted to be a stay-at-home mom. I always was. And we realized my husband was busy working. We realized we needed to add investments to our income. You can't just have job income. So we started investing in real estate, and we played it really safe at first with single family residential investments. So safe, it was actually a vacation condo. So I talk about this in our book, Real Estate Mistakes. It was a very common move that investors make after they move past the initial fear and start investing, because you want to do something familiar. So it was familiar to us because it was in ski country. We're avid skiers, and I was familiar with the area, and it felt like something we could also use while continuing to invest. So that was our very first investment that got us over the hump. It didn't turn out to be good nor bad. We talk about it, like I said, in our book. But from there, we moved on to more investment type properties, once again, single family homes. And we discovered this market I live in Toronto, Ontario. We discovered this market in Northern Ontario that we were actually started making our fortune buying $40,000 homes and renting them out for $1,000 a month. So we then transferred that model from a per door model and graduated from homes to actually buying apartment buildings. So I often joke and say we were like the mayor of that town because we owned the large majority probably of this city. And we were so set on this city. We were convinced it has strong economic fundamentals. We made a lot of money in that city. We helped bring a lot of people into that city as well. And we really thought we were doing the right thing for a long time. And that's where we accrued a large portion of our wealth, was graduating from single family to multifamily real estate by really kind of honing it down to a per door basis. So real estate investing, everything is per door. And I know a lot of multifamily investors say I wouldn't waste time with single family because you can make so much more money with multifamily, but in reality, you could also lose a lot of money in multifamily as well. It could be a very low cap rate. There could be no growth to it. So really what we always have to be doing is translating it down to very, very simple terms. And what are the operations per door and how much cash am I actually getting in my pocket every month, as well as how much income am I creating? So that was the start of our journey. I mean, we were 9 hours north of where we live now, and we thought we were doing everything right. And we had hundreds of properties in the portfolio and brought a lot of activity. And guess what happened?
Oh, you tell me.
Oh, it all went bad. No, we had a bit of change of government, and a lot happened in that area because it's a large mining town. And the change of government, they stopped the roads and all the traffic driven to that area. And all of a sudden, we were not making $1,000 a month per door. We were making negative $1,000 a month per door, probably. Ooh. Because of vacancies and distance. And so we learned a lot, and we talk about that a lot in our book, Real Estate Mistakes. But I'm very grateful for that, because every time we figure out what not to do, that's what we like to share with other investors and with our community at our
I don't even know if you would consider that a mistake, because you're investing into what would be a thriving place. You've built up the your door count and your rents were at a phenomenal basis compared to the cost basis. But then you had a change in legislation, government, just the things that are totally out of your control. I don't know if that constitutes as a mistake. It's more of timing and a victim of circumstance.
And a reality in
Yeah.
investments. And I think a lot of what we've been dealing with the past 3 years have been a lot of realities that none of us have any control. We had a lot of change in politics. We have like a poor global climate. We have a lot of things happening that we're all sort of waiting on, that has everyone kind of waiting on and suffering in the process. But a lot of investors have been stuck. A lot of investments have gone down. And it doesn't have to be anyone's fault. I think it's kind of like COVID-19. Who saw that coming? But now that we could look back, hindsight's 2020, we could sort of see now all the lessons that we learned from that time. Similar to now, we have to kind of learn in real time, how can we really recession proof our investments so they are okay with different things that may happen that we may or may not have control of.
Yeah. Well, that's when we're underwriting properties, we will, of course, we look at all aspects, all avenues, and especially on vouchers. What is the voucher paying for this same unit? Not necessarily market rate, and that's kept us pretty safe going into tertiary territories where your population isn't declining, but it's not growing. It's just steady Betty. But again, you don't know what you don't know. So I guess there's learning lessons that create wisdom, not necessarily. I mean, there's mistakes, but some of it's like unavoidable if all the things are good when you're going in, all the things make sense. But what are you seeing in today's market as far as investing? What are you giving guidance to?
Well, we're out of tertiary markets and we're in the A+ areas.
Yeah.
There's no need for tertiary now with the home prices. They're so low. And in A+ areas, why go far when we need to go to areas where people need housing? I know the housing crisis is a bit up and down. On one hand, people say there's no places to live. And on the other hand, people say, I can't find renters. So it really is sort of finding that sort of slippery slope. But it really is the time to be buying and developing right now housing for people in these areas, because prices are down all across the board in areas we'd never be able to get into before. Now a lot of them are for sale and there's a lot of opportunity. And we always need housing. As long as we're creating good products for good people that are going to need it, then we've won like 99% of the battle. It's just comes down to like AI can't replace housing even. So as long as people want to live there, don't go 9 hours away from your main city center like we did.
Yeah.
All those many years ago.
I like tertiary. I like path of progress tertiary. You see development on the horizon, but it's not to you yet. And then I like workforce housing. I like voucher housing. I like having a voucher as a contract backed by the government. So if the government fails to pay, nothing else matters anyways. But you mentioned AI, and that's one of the biggest things that I would be underwriting would be what is AI going to displace? What market segment, white collar, and then what does that tenant demographic look like in the A+ areas? And are those jobs even going to be around in 2 years for those A+ properties to be able to produce the rent to pay the mortgage? Because there's going to be a disruption regardless. There's Claude, Cowork. I don't know if you're using AI, but you can build any kind of dashboard right now, and dashboards that you would typically hire people to build for you to find clarity on numbers. I mean, and you can build anything beyond just number dashboards. But what is your take on that?
Well, I've been doing that. I've been spending a lot of my time building things and replacing like a lot of staff. People that used to have to do things and I'd have to pay like hundreds of thousands of dollars to do, it can be replaced now with AI. And it's really simplifying things in that terms for business owners and operators. I also had a huge argument with AI this morning. It was just a very generic ChatGPT thing, but they weren't giving me what I needed. So AI is great, but it's also not the be all and end all. And you need operators behind it to know what you're doing. So I can do things now I would never be able to do before. Like creating a landing page, for example. I could just get the HTML code and I have no technology skills, but I know what to tell it and I can just port it right over and get it to do this
You
for
got to
me.
get beyond ChatGPT. Go into Claude Cowork. Claude
Mhm.
Cowork is doing it for you. You don't have to copy and paste.
But at the end of the day, when you get it and you do it for it, you have to be the one kind of like, I find that it needs still a little bit of a human touch behind it. And people are now with the consulting, they're really like, who needs a real estate consultant? I could just go into to ChatGPT or to Claude or to wherever, to all these different AI technologies and get my advice there. And yes, you can get advice there, but are you getting advice from people who actually know your exact situation, what you're trying to achieve, and who have personally been there, that can really use their human experiences? And I think that's what really distinguishes real estate investors, good real estate investors, from just a person who's buying, selling homes for income or just raising capital, for income. Sometimes you do need some of that human experience and touch to go in there and really use, what they actually learn in the trenches, because the premise of the book, Real Estate Mistakes, really was learning is through doing. And that's really what makes consultants amazing consultants. And it's hard to replace consultants with robots. So yes, they can get information there, but is it the information that they need? And is it the small humanized tweaks that really helps you eliminate your margin for error or minimize your margin for error? What's good on paper? It's like real estate. If you're only focused on cap rates and in a numerical sense, which is what ChatGPT will do, then you could be chasing cap rates. It could be paper deals. Just looks good on paper, but in reality, it's a really tumultuous situation that you would be buying, and if you were to acquire that position. So yes, ChatGPT can be very helpful in certain things, or AI in certain things. I mean, for our Financial Freedom Summit, we interviewed someone who underwrites private equity deals, and it has AI analyzing offering memorandums. Like, that is a very powerful tool for people to be able to use. If you guys are invited to a seminar and you're encouraged to invest your hard-earned money, or maybe even your IRA or 401k, into some of these deals, how cool is it that this can even give you an extra buffer of analysis? It is fantastic. But it's always good to also have a really solid EMD or trusted source of boots on the ground to really be able to speak face to face to as well, and say, is this really what's best for me?
Yeah, no, I totally agree. You're 100% correct. Everyone, you still want a guide in a sense. Somebody's going to hold your hand to get to the end result while you're using your tools. But what I feel like AI is going to be exploiting is more of the middle, the tasks that get done with a human touch behind a computer that don't need the human. Those are the things that are just going to get decimated throughout the economy, and those jobs are typically 150 to 250,000 a year. How many of those need to go away and are never coming back? And then you've got Class A properties that are basically stood up with those high-paying careers that may or may not be around. I think that's my biggest piece on when you're selecting your asset types. You're also selecting what workforce housing type you're investing into as well. And I think tenant demographics means a lot. What does it look like on the horizon? Because there's going to be disruption. There's already disruption. You see reports coming out of job cuts every other week, every week. Just what does it look like on these jobs that are not coming back, and then what's getting recreated after these are gone. So I think we just need to be cautious and aware, and invest wisely too into what we're investing in.
Yeah.
Tell us about your experience with bringing someone who doesn't know a whole lot about real estate and bringing them through your journey to get them to where they're comfortable, and you've guided them.
Well, we really like to ask people first, identify what is it they're trying to achieve in regards to building wealth through real estate and alternative investments. Do they want to be a passive investor, which means partner with someone and write a check and they'll do all the work and they just get access to great returns? Or do they want to be an active investor where they're going to have to acquire this property and manage this property? A lot of people call real estate passive investment. I believe it's only passive tax-wise, because you are working for every door. Even if you have a property manager, you're managing the property management. You always have to keep an eye on your investment unless you and I were partners, I send you a check and you're in charge of the whole thing. But what extent do they want to be involved in what works best for them and their lifestyle? What return on investment do they need? And what are they doing this for in the first place? The beauty about multifamily real estate is I can train people to be full-time real estate investors like me and create a real estate business. But most of our clients are professional people, probably a lot of them that are going to be replaced by AI. So thanks for saying that. No, I'm kidding. It's a reality though. And professional people who want to have a better return on their investment, and they're busy working and with their families and, driving kids around after work. And they just want a better return than they had before. So the beauty with multi is people can get involved with one multifamily property and own that either passively, through a fund. That's a great way to get a great return on your investment, or to even own it themselves. And it could be a smaller multifamily. It doesn't have to be a huge investment. With all this MLI Select that's going on too, like we just had someone that was advertising a 23-unit property that a high net worth investor can get in with 90% fund, actually 95% funding, and have their capital returned to them. So it's really almost unheard of what the way people can maneuver their way around and then have this one really solid asset in their portfolio. And that could be it for them. But that has to equate to what is their main goal. Do they just want a multi-million-dollar retirement, which everyone needs to retire? Or do they want to be able to help their kids out? Or do they want more freedom in their life? Like what is the main purpose that they want this asset for in the first place? Because each type of investment will give a different type of return. Some are more equity, some are just cash flow, some could be a hybrid of both. So we always want to find out what people are doing this for in the first place. What can they do? If you don't have the money available, it's no point of pursuing it in those areas. We always have different areas at different price points, and what they're doing it for in the first place. Those are the main things that we focus on.
Nice, good deal. What about alternative investments other than multifamily, like data centers or hotel, or what other asset types? Any?
Yes, absolutely. So hotels are like an amazing asset class that people can actually invest in through a private equity fund or through small groups. I have investors that are doing this with just a small group of investors buying hotels. Hotels are a great investment because you have the real estate asset. Often you have the branding. So you get that notoriety for it. And plus you also have the income approach. Anytime we add an income approach to our actual real estate, now you are kind of on steroids. And that's when you get those really high cap rates, because you're looking at cap rate from real estate plus cap rate from income, the income created from it. So I like how those kind of create those multiple exit strategies for sure.
Also has the depreciation on the FF&E, furniture, fixtures, and equipment. There's depending on the location, the brand, the strategy, hotels can be great. They could be a trap as well. Just make sure you're
horrible. They could be a family. Whenever anyone out there, you guys are going to buy a business of any sort or investment of any sort, unless you see yourself behind the counter there and checking people in, you and your mom and your dad, and a lot of these newer immigrants buy the hotels. But usually, if you're truly looking to add businesses and real estate with income purposes, the best thing that you really do want to add to your portfolio is something that's already operated and has those full systems done. You're still not passive, guys. You still got to watch those people and watch your staff and your operators. When the cat's away, the mice play. But say if you own a Subway, you don't want to be making the sandwiches behind the counter. You want someone else doing that. So I think otherwise we're just giving ourselves jobs. Really.
I'm good with that though. I'm operator first mentality. I mean, any property we purchase, we're first in line, and we can press as hard as we want on the gas pedal to make sure things operate like they should. It's asset protection too.
But you're not checking in people at your hotel, right?
Definitely not. You can't.
Big difference.
But if you're guiding the ship and you're giving direction, setting expectations, and making sure that everyone's in line, your payroll's not getting too high, your capex on maintenance isn't going crazy because you're purchasing at retail and everything. Just all the things. Yep. It can be death by a million paper cuts if you're not directly involved and in the weeds. And
Absolutely.
that's what happens a lot of times. So
100%. You just hit that nail on the head. This is why real estate's not passive. It's active,
right.
because even if everyone else is doing everything, you are managing it. Even the accounting aspect, if you're not looking at everything going on, you're all just, because people get very important in self-importance in the sense of real estate. Oh, I just have my people doing it. I have my staff doing it. Even with social media and all these sort of things, we keep an eye on it. Oh, I have my staff, just my team is just going to do it. I'm like, your team needs to do things a little better. If you were watching your team, then you'd know the team is running things, the way that's your standard. Same with real estate. So I think you always, if you're an active operator, you always have to have, your eye on the prize, your finger on the pulse, and make sure there are no gaps. It's like death by 1,000 paper cuts in real estate a lot of the times. And if you're not focusing on the numbers and focusing on the entire operations, those small leaks can just sink your investments. And that's really what's been happening.
Yeah, no, I agree. It's well, that is what happened. A lot of syndicators got out in front. They overspent. They put people in front of them, i.e., the property management company. Property management company puts people in front of them because they don't want to deal with it. And at the end of the day, the people that are running the property have no experience in running properties. And that's where you can step too far from the plate. You can put people in front of you and that shouldn't be in front of you at all. And then you just get a show, and then you got to clean up the mess. If you catch it in time, you can clean up the mess. If not, then something you got to deal with. But very good. If somebody wants to reach out to you, Monika, learn more about yourself, learn more about your program, how can they get a hold of you?
Come visit us at rpieducation.com or find us on Insta at RPI Education.
Awesome. Monika, definitely appreciate your time. Look forward to following you. Thank you.
Thank you so much.
All right. Bye.